Hey, this is Chris Franco, and you are listening to Compound Money Quietly, the CMQ Investing podcast. CMQ investors, welcome to the show. It's great to have you here. This episode was originally an Instagram Live broadcast just from a couple days ago on October 3rd, 2021. By the time you're done listening, you will have learned about Charlie Munger's latest investment success in the real estate game, and the really amazing story of how it all came to be. You'll also know about Apple's dominant position in the gaming world and the threats that they're facing trying to maintain that position. And finally, you'll have new historical perspective about the bond market, and you'll gain some timeless wisdom from one of my favorite columnists, Jason Zweig of the Wall Street Journal. As I always say, and I hate to be a nudge, but make sure you follow on Apple Podcasts and Spotify, leave a written review, give us a 5-star rating, tell a friend, post about it on social media. All of that goes a long way, and as I always say, and I'll say it again, I really do appreciate it. Without further ado, let's get to it. Billionaire investor Charlie Munger made a well-timed bet on suburban apartments thanks to a neighborhood teenager who showed up at his house with a Hebrew Bible. Munger couldn't read it, but the encounter led to an improbable friendship and more than a decade later, an investment in California apartment complexes before the pandemic sent values soaring. The young man's business, Afton Properties, has become a force in the market in the past few years. It bought more apartments in California than anyone else in 2020, on its way to building a real estate portfolio with an estimated value of $1.2 billion, according to Real Capital Analytics. Munger and Afton declined to comment on how much of that growth was funded by the 97-year-old investor, who's best known as Warren Buffett's longtime business partner. Still, Munger's public remarks and other data provide a glimpse into a little-known chapter in his storied investment career. Afton, run by Avi Meyer and Reuven Graydon, has focused on an unglamorous corner of the real estate market, garden-style apartment buildings in the vast sprawl of Southern California. They spent $423 million last year on more than 1,700 units, and the purchases have continued in 2021, according to RCA data. They're still on the hunt and prepared to make all-cash offers for apartment complexes. They were one of the first to see the secondary markets had potential, said Otto Ozen, executive vice president at the Mogerby Group, a multifamily investment banking firm in California that has closed deals with Afton. They're buying with a long-term hold strategy. With Americans struggling to find affordable properties to buy, demand for apartments is at the highest level since the 1970s. That's pushing rents higher at a startling pace and boosting the value of apartments. Prices for multifamily buildings gained 15% in the year through August, according to RCA. In the Antelope Valley and Inland Empire, north and east of Los Angeles respectively, rents climbed about 16% from April of last year through June, according to data compiled by Marcus and Millichap, a real estate brokerage and consulting firm. In downtown Los Angeles, rents fell 8.1% during the same period. In all three areas, the prices investors are paying for apartments have jumped since the start of the pandemic. The story of how Munger came to invest in apartments began about a decade and a half ago, and this is a quote from Charlie Munger. One day, into my house, a very young 17-year-old Hasidic Jew came by and gave me the Hebrew Bible, in Hebrew, Munger recalled at an event last year in Redlands, California. They struck up a friendship, and years later, Munger suggested they partner to purchase buildings. Loan documents for one of the first properties they bought show how things have improved. Occupancy increased to 98% last year, from 95% in 2019, while net operating income climbed 15% to $6.9 million. Part of the strategy is to upgrade the complexes they buy, Munger said, noting they spent $600,000 on trees in the first year. There's more money to be made taking care of the customer, he added. It'd be nice if I were Mother Teresa and did something I didn't like doing because I'm a noble soul, Munger said, but my life is organized so that time after time, what works for my pocketbook works for every moral teaching that I've been taught, end quote. All right, now this next article here is about Apple. I have not read it yet, so I'm not sure what it encompasses, but it just caught my attention. And it's in the Wall Street Journal, and it's titled, Apple Doesn't Make Video Games, but It's the Hottest Player in Gaming. How CEO Tim Cook quietly turned the iPhone company into a superpower in the video game business. Now he's fighting rivals in a multiplayer universe. This is by Tim Higgins, and it was posted, or at least updated yesterday, October 2nd, 2021. It reads, Apple doesn't make hot video games such as Fortnite or consoles such as Xbox, but with little fanfare, Chief Executive Tim Cook has turned the maker of the iPhone into one of the world's largest video game companies. The key is the App Store, its digital marketplace, where the company sells and distributes thousands of games by other companies and developers, from Epic Game Inc.'s Fortnite to Tencent Holdings' Honor of Kings, and takes a 30% cut of sales. Woof. That explains a lot about the tech giant's current battles with rivals. Apple raked in more profits from games than Xbox maker Microsoft, gaming giants Nintendo, and Active Blizzard Inc. and PlayStation maker Sony Corp. Combined in its fiscal year 2019, according to the Wall Street Journal's analysis of figures released as part of the company's recent antitrust trial. Did anyone realize that? That's insane. Apple's operating profits from games that year totaled $8.5 billion, according to the journal's analysis, exceeding the other four companies' combined gaming operating incomes in the same period. The tech giant said operating margins discussed during the trial were flawed and as a result are too high. Apple's dominance, however, is under threat. Its position as the gatekeeper to the gaming economy places it at odds with Facebook, Microsoft, and Fortnite maker Epic Games, as each company prepares for the next frontier in technology, virtual reality. Many digital activities, from search to social to shopping to live events, could take place inside of games in the coming years. Industry global revenue from video games is expected to almost double from $198 billion in 2024 compared with 2016, according to estimates by technology consulting firm Activate Inc. The biggest chunk of that growth is from mobile games, which Activate predicts will generate $103 billion in 2024. The risk for Apple is that its role as the gatekeeper between the gaming world and its more than 1 billion iPhone users, as well as the fee it collects as the middleman, could be disrupted, whether by legislation, court order, or regulatory action. Epic sued the company in 2020, alleging that it stifled competition. Because of Epic's lawsuit and increased scrutiny of Apple's sway, lawmakers and regulators from Washington to Brussels are considering ways to potentially upend the company's power, which some fear hurts rivals. Another threat to Apple's profit engine comes from China. New rules in the country aim to decrease the number of hours young people can play games. Three of the top 5 grossing mobile games in the App Store are from China, including the number one title, Honor of Kings, from Tencent, which generated an estimated $2.5 billion last year from users, according to analytics firm Sensor Tower. Globally, consumers spent a total of $45 billion on mobile games through the App Store in fiscal 2020. Almost 31% of that money was spent in China, while 26% was in the US. Apple's cut came from an estimated $13.5 billion, or about 5% of Apple's overall sales that year of $275 billion. 50% of Apple's revenue came from hardware sales of iPhones. Apple doesn't break out revenue from the App Store. Instead, it includes the business as part of its services category, which it said generated $53.8 billion in sales last year. That category also includes music, iCloud, Apple TV, advertising, and extended warranties. It doesn't say how profitable each of its product categories is, but disclosed an overall company operating profit of $66.29 billion during the period. The article continues. That such a large part of Apple's business comes from the gaming world is almost a fluke. After releasing the iPhone in 2007 and seeing developers hack their gadgets, it designed the App Store so users could download third-party software to their phones under Apple's control. Apple's late co-founder Steve Jobs and his team came to realize that the store could be a new goldmine. In 2008, the year the App Store launched, it had 500 apps, many of them games. Apple's profits from gaming got bigger as the app economy expanded. The shift became even more important under Mr. Cook as he looked to combat stagnating iPhone sales. In a nod to how important hardcore gamers are to the company now, Apple introduced its new iPhone 13 Pro last month with upgrades to the screen aimed at giving a smoother video experience. The feature is particularly attractive to those who use it for gaming. Apple is appealing to a rather small group. Just 6% of App Store game customers in 2017 accounted for 88% of all the store's game billings for the year, according to court records. On average, they spend more than $750 annually. The biggest spenders, who made up 1% of Apple's gamers, generated 64% of billings and spent on average $2,694 annually. Wow. Let's get to this Jason Zweig article about bonds, and then I'll get to all your questions. By the way, this is a totally new format. I'm just I pulled up 3 things I wanted to talk about and read about, and we're just doing it together. This is called When Interest Rates Turn the Corner. 40 years ago marked the start of a bull market in bonds that would last for decades. No one saw it coming. By the way, Jason Zweig from the Wall Street Journal is one of my favorite journalists, period, to read about. He very much, if you like Charlie Munger, if you like Compound Money Quietly, CMQ Investing, everything that we're kind of all about, I feel like he's the man. Jason Zweig is the man. Well, it's one of my goals, I'd say maybe within a year, to get him on the podcast. And I think if we keep growing, that's realistic. Okay, let's get into it. Jason Zweig writes, "Have I got a deal for you? You can buy mortgage bonds priced to yield 17.85% over the next 10 years or 18.75% over the next 20 years. They're investment grade, not junk bonds. The only catch? You have to buy them on September 30th, 1981. Incredible as it might seem, on that day and at those rates, you probably would have turned my offer down. Most of the time in markets, hindsight is 20/20, but foresight is legally blind. September 30th, 1981 turned out to be the exact day long-term U.S. interest rates peaked, ushering in a multi-decade bull market in bonds. We know that now, precisely 40 years later, all anyone knew then was that bond prices, which move in the opposite direction of yields, had just set yet another record low. The next day, the Alaska Housing Finance Corp ran what looked like a proud tombstone ad in the Wall Street Journal commemorating a successful offering for those mortgage bonds. In fact, the deal was a dud, with only about half sold by day's end, our reporter Tim Herman pointed out on October 1st, 1981. Quote, "Bond salesmen say they are having an increasingly difficult time persuading investors to buy long-term bonds, even though many debt issues today offer record yields." Added a senior Wall Street executive, quote, "It's been a dreadful week, and it's only Wednesday," end quote. The prices of some government bonds had dropped as much as 17% in the previous 3 months, including a 6% plunge the prior week in September. For years, quote, "bonds have been going down and down and down and down," recalls Dan Fuss, Dan Fuss, I love these names, then a 48-year-old portfolio manager and now vice chairman at investment firm Loomis, Sayles & Co. Between September 1977 and September 1981, the yield on outstanding long-term corporate bonds had shot from 7.92% to 15.49%. Younger people might say today, "That's impossible. Bond markets don't collapse like that." Yes, they can, Mr. Fuss says. He made quite a fuss about that. Wall Street firms, then nearly all organized as partnerships, were reluctant to risk their capital to support a faltering market. Sellers, often facing huge haircuts on their bonds, were loath to lock in a loss by selling. Buyers, convinced rates would keep rising, locked up their wallets. Liquidity was terrible, recalls Bill Gross, co-founder of the giant investment firm PIMCO, now a private investor. Some of his clients, while they'd done well at PIMCO, had lost as much as 50% elsewhere in their bond portfolios. "I didn't know how long they would stay with us if they kept losing money like that," Mr. Gross remembers. "You'd go home at night and just wonder why the hell you should bother going back in the morning." Mr. Gross was nevertheless bullish, as was Mr. Fuss, given how cheap bonds were. But with short-term money market funds yielding 17% or more, the vast majority of investors had no appetite for long-term bonds. The credit markets might become comatose, E.F. Hutton & Co. President George Ball warned in the Journal on September 28, 1981. In exactly 40 years, we've come almost precisely 180 degrees. See, this is why I wanted to read this. I love getting the historical perspective. The article continues, and it's just a little bit longer here. The last week of September 1981, almost no one thought interest rates could go significantly lower. Up until a few days ago in September 2021, almost nobody believed interest rates could go significantly higher. On September 30th, 1981, to get investors to buy $1.75 billion in 20-year Treasury bonds, the U.S. government had to offer them at a 15.78% yield, more than 2 percentage points higher than a similar issue had yielded in an auction 2 months earlier. Even today, nobody has a clear explanation of why bonds suddenly seem more attractive on October 1st, 1981 than they had the day before. Over the next 6 trading days, long-term yields fell more than a full percentage point. By Thanksgiving, they dropped below 13%, one of the sharpest declines in history. By September 30th, 1982, the 20-year Treasury yield shrank to 11.65%. By the same date, in 1986, it hit 7.55%, more than 50% below its peak just 5 years earlier. The inescapable lesson of September 30th, 1981, and this is the lesson for all of us, is that markets can keep moving in the same direction longer than anyone can imagine, and then shoot explosively in the opposite direction when no one expects it, impelled by forces no one may ever fully understand. Let's just recap that. The inescapable lesson of September 30th, 1981 is that markets can keep moving in the same direction longer than anyone can imagine, and then shoot explosively in the opposite direction when no one expects it, impelled by forces no one may ever fully understand. On a long-term chart of bond yields today, September 30th, 1981 looks like one of the most glaringly obvious turning points in financial history. On that day, however, it was just another dark data point in a miserable, seemingly endless slog. Because we can see the past as clear as day, it's all too easy to forget that the future is always enshrouded in fog. Things can't go on forever at these rates, says Mr. Gross. Interest rates can't stay this low net of inflation because savers, whether it's mom and pop in Des Moines or big pension funds, can't earn anything on their investment. He adds, for the economy to survive, at some point, interest rates have to regain some semblance of an attraction to savers. Otherwise, the savings function will be destroyed, end quote. No one knows when that time will come, but come it will. All right. I'm going to wave back to everybody. Thanks for everybody who's joined. I just went through an article from Bloomberg about Charlie Munger's latest foray in real estate investing. We talked about Apple and their dominance and the threat to their dominance in the video game world. And we just read through the latest from Jason Zweig of the Wall Street Journal, giving us some history on the bond markets and just offering a really useful lesson as investors to remember and hopefully internalize and apply. And all of this has been done totally off the cuff, live. There's no, I had not read any of these articles except for the one about Charlie Munger. So if I stumbled occasionally, please forgive me. NJ Phone Shop says, what's up, bro? What's up, NJ Phone Shop? Good to see you, man. Spencer Weiss is in here. What's up, Spencer? Matthew Vance Gorham says, opinions on crypto savings accounts. I don't know about crypto savings accounts, but let me look them up real quick. Christophe Noor, who I've seen before. What's up, Christophe? Says, greetings from France. Real Josh says, are you invested in the semiconductor stocks? What do you think of the current semiconductor shortage situation? I am indirectly through index funds, but I did have, for a while, I made some money on Micron Technology. That was one I held for a while, but I'm out of that. Okay, what is your favorite part of CM's small portfolio of companies? Asks Jay Fassler 15. What's up, Jay Fassler? I recognize your name. Well, I don't know everything that's in his portfolio right now. We mentioned we were just talking about real estate, but I think just him personally, I think Berkshire. I think Berkshire is an awesome company. I mean, it's not a really earth-shattering revelation, but I like I really understand why Charlie Munger invests in what he invests in. It doesn't mean that everything he's invested in is a good investment right now for you, because the price at this point could be well above what he paid when he got in, and in many cases it is. But I think you look at Berkshire Hathaway, Costco, those two alone. I mean, they're great businesses that have a very little, if any, chance of going to zero. He also invests in companies that he feels have a certain like moral, ethical integrity, and that does help a lot over the long haul. Some of investments that I've had, like Facebook as an example, anytime Facebook gets into some sort of ethical trouble, it causes the stock to drop quite a bit, and in other cases they get fined a lot of money, and that hurts earnings. So management with a lot of integrity matters a lot. Maury Samiri says Apple also has a very high barrier to entry based on the ease of use in their entire ecosystem. The value of that type of franchise doesn't show up on a balance sheet. Yeah, look, I think that's one of their strengths, absolutely, and very high switching costs, and they're able to convert more people over now with their ecosystem. Once someone buys an iPhone, they're likely to buy AirPods. They're likely to have an iCloud account. There's all these. They kind of feed you the medicine, and then you start getting more of the medicine, and before you know it, you're hooked. And I don't look at that as a bad thing when, in fact, I feel like they add more value to me as a consumer than they do, take away from my pocketbook. I feel like it's a win-win situation. Which, if they were just luring you in, like, come on in, buy an iPhone, and we have you for life. That's not the kind of company I prefer to be involved with. But I feel like this is just me speaking as a consumer. there's very few companies I can think of that over the course of my lifetime have consistently delighted me. And really, I feel like I've gotten the most for my dollar with them, even if they do have higher price point items. That's just my personal opinion. So I've been in on Apple since 2014 as an individual holding, and I don't have any plans to sell. Fitness real estate agent says they call it deepening the relationship in banking. They start you with one product, then you start purchasing more. Absolutely. And he says, so you will be less likely to leave the company. Right. And in Apple's case, they call it their ecosystem. In banking, though, for example, like when you buy, just to go off this comment here, you might set up a Chase checking account, but the real money that Chase makes over time is, could be when you get a mortgage for your home, or, you do you need a loan for something. You get them in the door with one thing, hopefully at a reasonable acquisition cost. And then from there, you have all sorts of ways to cross promote and upsell. And it's all about that relationship. I think I did my mortgage with Wells Fargo, which it's because they've been so ethical. No, but I have not had a Wells Fargo checking account for a long time, but when I was younger, I definitely did. Again, that relationship began long ago. Maury Samiri says, thanks again. Keep in touch. Will do. Thanks for joining. This has been Compound Money Quietly, the CMQ Investing Podcast. My name is Chris Franco. Thank you for listening. We'll talk soon.